inflation is apparently low and declining. The economy is still strong. In that sort of environment, gold is not the asset of choice. Now, I think that's shifting as more and more people see that, either they see more and more people are beginning to see that the economy is slowing, and the unemployment rate going up in the US 4 months in a row is one thing. And of course, the most important thing is Jerome Powell's speech on Friday at Jackson Hole, where he said the time has come to change policy, to shift policy. So the expectation is for an interest rate cut next month. And typically when the Fed first cuts interest rates, you see gold, gain traction. So I think over the next month, we're going to see more and more individuals and retail start moving into the gold space.
Hey guys, welcome back to Capital Cosm. Today, I've got Adrian Day back on the show, my good friend. How are you?
I'm fine, thank you, Danny. Thank you for having me back.
Yeah, it's a pleasure to have you on. Thanks for coming on. Before we get started, guys, I'd like to remind you to hit that subscribe button if you haven't already. Be sure to hit that like button if you get value out of these videos. And with that said, Adrian, what are you seeing out there in terms of broad strokes in the economy, the markets in general? Let's keep it macro for now, and then we can kind of hone in on specific topics.
Sure.
So what's front and center on your radar screen?
Well, in very broad strokes, I mean, first of all, the U.S. economy, to me, I won't keep saying to me, I'll just say, the U.S. economy is clearly slowing. Manufacturing's been weak for a while, but other parts of the economy are slowing as well. And in my view, particularly the unemployment, the labor picture is nowhere near as strong as even it looks today, if you just look at the headline numbers. But certainly nowhere near as strong as it looked last week before that absolutely outrageous jobs revision from the Bureau of Labor Statistics. Anyway, we can talk about the labor picture, the employment picture if you want, but I think it's a lot worse than it appears. That's one thing. The consumer, I don't think, is anywhere near as strong as the headlines would suggest. Consumer spending is up, but if you look under the hood and look at the patterns, it's not that strong at all. Clearly, there's a bifurcated economy. The bottom half, or even bottom 60 or 70%, are struggling in various degrees, and so that's hidden by the aggregate numbers. So that's one broad stroke. I think the other thing is, if we look at markets, it strikes me that most developed markets around the world are overvalued and vulnerable. So in this business, I think it's important that if you're managing money, what's important is not that you make predictions that turn out to be right. What's important is that you assess risk and reward and capitalize on the reward or potential and try to minimize the risk. So in terms of risk reward, the major developed markets around the world, other than Japan and China, appear to me to be very vulnerable right now, particularly the stocks that have led. So in the US, that would be the big cap tech stocks that have led, extremely vulnerable right now. Those are some of the main, and gold, of course, and commodities generally, frankly. I mean, I had to laugh. There was an article on Bloomberg just last week, pointed out to me by Jesse Felder, and the theme was the decade-long bull market in commodities is now over. And
Decade-long?
First of all, I don't know anything about a decade-long bull market, but apart from that, I mean, my gosh, you look at commodities against equities, against financial assets, and we are basically at 100-year lows. So yes, we've had a bit of a run, certainly, and we've had a bit of a run in some of the commodities over the last couple of years. But to say that the super cycle is over, I mean, to me, commodities, broadly speaking, are a very strong buy right now. We can get into that, but particularly gold and silver, the monetary metals, particularly. So is that enough on a broad stroke?
That is as broad as it gets, sir. So let's go ahead and dig into gold and silver, as well as commodity. So while commodities have been kind of in this sideways moving state, gold has been making new all-time highs. It's pretty much the rock star asset of, let's say, the better part of this year. Silver is also doing pretty well, not as well as gold, still 40% off its all-time high at a pretty, decent discount there. Why do you think we've seen this decoupling from the commodities complex as well as the gold price, or is gold simply a leading indicator for what's to come to the commodities complex at some later point?
No, that's a good question. I think what we've got to do is look at who's been buying gold and why have they been buying gold. And for the last 18 months and virtually all of this year, the number one buyer of gold has been central banks. Well, central banks are trying to diversify their assets away from the dollar and avoid the weaponization of the dollar. Gold is a traditional central bank asset. But the central bank of Uzbekistan or of China, for that matter, or Germany or anywhere else, they're going to buy physical gold. They're not going to buy drums of uranium for their central bank reserves. They're not going to buy uranium, as perhaps a bad example, because uranium has done well. I mean, we can talk about that later. But they're going to buy gold and virtually to the exclusion of everything else. They're certainly not going to be buying Newmont or Barrick if they're trying to get away from the weaponization of the dollar. The number two buyer of gold in the last 6 months has been Chinese investors who are, again, anxious about the banking system in China, anxious about the depreciation in the yuan and the slowdown in the economy there. They want to take their money out of banks because the banking system is seen as not safe. They don't want to put it into equities, but have declined, 40%? They've just slid and slid and slid for the last year and a half, 2 years. If you're looking to protect your assets, you don't go there. They're not allowed to buy crypto. So gold, which has been a historic store of value in China for Chinese people, is the natural place where they turn. Again, a Chinese investor trying to protect himself against a slowdown in that economy and the depreciation of the yuan is not going to start picking up North American gold stocks. I mean, typically, Chinese investors don't buy a lot of gold equities anyway, but particularly North American gold stocks. And so if you look at who's buying and why they're buying, it makes absolute sense that most of the money has been going into gold, physical gold, not into silver, not into gold stocks, not into other commodities. That all makes sense. And of course, as we all know, gold and silver are monetary metals. Silver also has industrial, but that is still a monetary metal. And the other metals are not. So they do react, even though they frequently move at the same time, because some factors, like the dollar, for example, the level of interest rates, for example, inflation, those things will have a similar effect on all commodities. But then there are other factors that will be positive for gold but don't affect other commodities. And there'll be other factors, primarily, of course, the state of the global economy, that will affect commodities, but not necessarily affect gold and silver. And we know that.
Right. So let's kind of unpack that for a bit. It does appear like this rally in gold over this past year has been precipitated by these central banks. You don't see it in like the Google Trends analytics where people are searching to buy gold or anything to that effect. When does that happen? My part two of this question is, are we a bit overbought on gold at the moment, or do you still see a lot of runway in terms of opportunity for someone who's thinking of deploying capital right now into the gold market?
Yeah, I think we have been beginning to see a little bit of movement from, and I'll break it down, from Western investors generally, because for
Mhm.
Western investors, North America and Europe have actually been net sellers of gold up until very, very recently, and net sellers on a consistent basis pretty much all year. What we've been seeing in the last 4 6 weeks, we've started to see some pretty large OTC trades in London. And you don't see those trades reported individually, but you see the aggregate. And the suspicion is, and anecdotally, they seem to be large trades. The suspicion is that there are a relative few very wealthy families, maybe institutions, but families and individuals who are wanting to get into gold. There is still no broad rush by what we'll call individual or retail investors to move into gold. And you can see that in coins. You know more about that than I do, but the coin dealers I talk to say, yes, there's been a little bit of a shift, but certainly no large wholesale rush into buying physical. And earlier in the year, some of my coin dealer friends were telling me they were getting more people who called were wanting to sell their gold than actually buy it. You look at the gold ETFs as well, GLD. For the last month, we've had a little bit more on the inflow, but still pretty balanced between inflows and outflows. And up until this month, up until August, it's been pretty much consistent selling, 3 or 4 days of selling for every 1 day of buying. That's beginning to shift, though, as I say, it's beginning to shift. So we're now seeing maybe 2 days of 3 days of buying for every 2 days of outflows from the GLD. Just beginning to shift. I think the macroeconomic environment in the US and North America generally is not a positive. If you just took a snapshot, it's not really a positive environment for buying physical gold. Yes, the dollar's come down, but interest rates are still high. Inflation is apparently low and declining. The economy is still strong. In that sort of environment, gold is not the asset of choice. Now, I think that's shifting as more and more people see that, either they see more and more people are beginning to see that the economy is slowing, and the unemployment rate going up in the US 4 months in a row is one thing. And of course, the most important thing is Jerome Powell's speech on Friday at Jackson Hole, where he said the time has come to change policy, to shift policy. So the expectation is for an interest rate cut next month. And typically when the Fed first cuts interest rates, you see gold, gain traction. So I think over the next month, we're going to see more and more individuals and retail start moving into the gold space.
Gotcha. Well, what about the commodity space? Commodities have been not particularly strong, but also not really they've kind of been neutral, let's say.
Yeah.
With everything going on in the world, you have so many powder kegs that could explode out any moment now, which is very inflationary for, very much pertinent to inflation, supply side inflation. But nevertheless, commodities have relatively stayed neutral. Is the demand side on the economic front is so bad it's offsetting what would be a supply side inflationary crisis? Or is there something else I'm missing here, Adrian?
No, I think that's definitely part of it, particularly what's happening in the Chinese economy. Because as you know, we've had a slowdown in Chinese demand for copper, for steel, and probably for other commodities as well. And of course, again, the macroeconomic environment that I discussed, again, is not necessarily the most favorable for commodities. Obviously, a strong economy generally would be favorable. But with the Chinese economy, and China has been, the 50% or more, responsible for 50% or more of the demand for most commodities. China is much more important than the rest of the world. So a slowing economy, a slowing global economy is not good for commodities generally. And again, high interest rates are not positive, and lower inflation is not positive. I think the dynamic, so in the commodity space, I would tend to be much more selective about what I'm buying and what I'm not buying and what my time frame is. So very, very bullish on copper, for example, on a 3 to 5 year basis. Who knows what's going to happen, this year. I'm a bit surprised. Well, in a way, I'm a bit surprised that it came off as much as it did. But I have to say, I was also a bit surprised it moved up as much as it did before it started falling. So maybe it's back where I thought it would be. But the next 6 months may or may not be favorable for copper because of the demand patterns in China. But I think on a 3 to 5 year basis, it is, as all of the analysts are saying, it's very, very favorable. Both because of the demand side, the traditional demand, the infrastructure, and also, of course, the electrification. And so even if the demand expectations are only half or 2/3 of what estimates are, the electrification slows down considerably over expectations, for example. I mean, I think the demand for EVs is going to be a little less than people are suggesting, over that time frame. But you've also got the supply picture. And the thing about copper, as you know, is it takes an awfully long time from discovery to production. Not only from discovery to production, but actually from when you have a project and decide to go ahead and build it. It can take 5 to 10 years from the decision to build. Got to raise the money, you've got to get the permits, and you've got to construct it. And these are big projects. And the point of that is that we have very, very good visibility on potential copper supply 5 years out. Some projects will move a little quicker than others. Some might be a little bigger than we thought. Some expansions will be built that we didn't expect. But we're very, very unlikely to have any significant source of copper supply in 5 years' time that we don't already know about, right? It's not already factored into people's models. And so even if everything was favorable, on the supply side, everything went smoothly. There's no more strikes in Chile. There's no more earthquakes in Chile. There's no more environmental holdups in the US. There's no more, environmental protests around mines in Peru, et cetera, et cetera. Everything goes as well as it possibly could be. We still will not have the copper in 5 years' time to meet the anticipated demand at today's price. So copper, I'm very favorable on. Uranium, I think, is very attractive right now. The uranium price, as has come off from its big run. And I think, and it moved up last week, but it's come off a lot in the last, 3-4 months. I think that's very, very favorable. Again, I think you want to have a longer term outlook on that, maybe 2 to 3 years on that. Those are the ones that I would be most focused on. I mean, I think some other commodities will do well. Oil, gas is so depressed, it's difficult to think that it could get much lower. But, of course, I, along with a lot of other people, were thinking that when the price was 50% higher. And the big thing about trying to buy, or the big thing about buying very, very depressed assets such as gas, particularly ones that are seasonal, like gas, is you have to have the staying power, and the investments you make have to be suitable for a long-term investment. So if you're looking at gas, you don't want to be buying one of those ETFs that trades on commodities, because the roll, when the contracts roll over and they rebuy them, and so the roll of the cost of continually rolling over those contracts is so high. But even if gas price stays where it is, you're going to lose 20, 30, 40% pretty quickly. If you're looking at gas companies, E&P companies, you want to make sure they have strong enough balance sheets to be able to withstand another 12 months of this depression. But I do think oil companies are quite attractive right now.
Gotcha. Are you in the market for gold and silver? Then if so, please consider Miles Franklin. They are my gold and silver dealer of choice. So not only do they have super competitive prices that you're going to have a really hard time finding elsewhere, but then they also have top-notch customer support. I know Andy Schechtman, the owner of Miles Franklin, top-notch guy. I wouldn't be recommending them to you if I didn't have faith in their product mode. What you really want to do, however, you want to email them at info@milesfranklin.com, and you want to say that Capital Cosm sent me in the description line, because when you do that, you can get access to their special pricing sheet. You want to get that special pricing sheet because you're going to get special prices that you won't find on the website itself. So email them at info@milesfranklin.com. Tell them that Capital Cosm sent you, and you won't be heckled with spam emails, etc. There's no commitment necessary. I promise you that. And with that said, I will let you get back to the video. What about silver in general? Its counterpart, its closely related counterpart gold has been performing quite well, but silver is still about at a 40% discount to its all-time high. Do you see opportunity when it comes to just physical silver, let's say, and then we can dive into the miners after that?
Yeah, no, absolutely. As everybody focuses on the differences between gold and silver on the demand side, and they are very significant, particularly with solar panels, because solar panels, I think, are going to probably continue their growth pattern, and the silver that they require is a meaningful part of the total silver market. Remember also that at the moment, a lot of solar panels, they don't last forever. So you can install solar panels, and within 10 years, you will definitely have to replace them, and that's more silver. There's also differences, of course, on the supply side. And the difference is important on a long-term basis, and it's important for how it affects the market. Let's say 30 years ago, 25 years ago, the majority of silver production was from primary silver mines. Today, at maximum, it's 30% of worldwide silver demand comes from a primary silver mine, and a primary silver mine might be a gold-silver mine that's 50-50, but most silver today is byproduct silver, and it's byproduct, not a gold, but it's of gold mine, but it's byproduct of lead or zinc. Now, this is really, really important, because what it means is that the silver supply does not respond very well to changes in the demand for silver and the price of silver. If silver goes to $30 tomorrow, your lead miner in Bolivia is not even going to think about expanding his lead production, because he's got 10% byproduct silver. The zinc miner in Peru is not going to produce more zinc just because the price of silver goes up. And that's true on the downside as well, of course. If silver collapses, you don't stop mining zinc just because your byproduct, because the byproducts tend to be relatively small, 10, 12%. And so the silver supply does not respond very well. And that's one of the reasons why silver can have these very, very exaggerated moves, leverage moves, if you like, both on the upside and the downside, simply because the supply doesn't respond. And that's different from gold, of course. You know, if you look at silver today, but having said all of that, the differences in supply and demand, silver, broadly speaking, tends to move broadly with gold in response to monetary factors. So with silver, you're getting a little bit of a best of both worlds, if you like. I mean, right now, if you look at silver year to date, it's actually performed just a little bit better than gold. Well, basically the same, but a little bit better, according to Bloomberg. Of course, it's come down, you know, it ran up sharply at the second half of, you know, in May and beginning of June. So it's come down from there. No, I think silver is very attractive right now, both as a physical and as the equities.
Yeah, it seems like there's a few opportunities out there, but I also want to get your views on cash. What do you think of you know, the treasury market right now? Do you, with all this economic weakness, you know, and you know, potentially on the horizon, what's the wisdom behind holding some cash in case of a buying opportunity in terms of like a broad market correction?
Yeah, you know, I'll say that in 30 years of managing other people's money, I have rarely regretted having a high cash position. I rarely say, oh my gosh, I have too much cash. So I think just in principle, it's always good to have some cash in reserve for two reasons. One is when people need cash, that need for cash, that need for urgent cash never comes at a good time, right? It generally comes when everything is weak and when markets are down. And so if you are fully invested, and I know people who are, you know, even leveraged and on margin, but you need money suddenly, it might only be $10,000. But if you have to sell something, you're probably having to sell it at a bad time. You never want to be in a position, to the extent you can, you know, but it's in your control. You never want to be in a position where you have to sell something. But I think also I mean, I can tell you what we're doing in our gold and silver accounts. We're pretty fully invested, and have been for the last 6 months. On a very short-term basis, actually beginning to raise just a little bit of cash today and Friday, but broadly speaking, very fully invested because I see the opportunities. In the global accounts, we are just slowly raising money, particularly for more conservative accounts, and you know, waiting for the opportunities. We will. There's little doubt that at some point over the next 12 months, we will see better opportunities in whether it's the German stock market or the big cap in the US or global equities generally. I think we will see better opportunities. So, you know, we're just building cash. We're not doing it as a timing mechanism, if that makes sense. I mean, we're doing it because we think equities are overvalued, so I'm slowly getting out of things that are overvalued. And if I'm not seeing things to buy that are good quality and undervalued, we're just holding on to the cash. So it's not a timing decision as such. And we're putting it into T-bills. We've been, you know, when you can get 5% on a 1-month T-bill, you know, that's pretty attractive right there. Now, unfortunately, or fortunately, whichever way you want to look at it, that is going to change. But for now, I'm certainly not buying 2-year bonds. I'm certainly not 2-year notes. I'm certainly not buying 30-year bonds. I have no idea who in their right mind would want to buy a 30-year treasury bond yielding, what is it now, 4.2 or something? Thinking that they're going to hold it. I mean, that just must be one of the worst investment risk rewards out there. And maybe you want to buy them on the auction and flip them. Maybe you're a trader, whatever, or maybe you're a pension fund that has to buy. But if you've got the choice and to buy that as an investment is just a silly idea. But to buy, and the same goes for 10 years, frankly. But to buy a 3 months, 6 months, and just collect the income right now, while you can, I think is attractive. Because of course you've got if markets act the way they normally do, when rates start to come down, it will be because the economy's slowing. And at that point, corporate earnings will be weakening and the stocks will come down. So holding cash now, while you can get 5% for 2, 3, or 4 months, will probably, the maturity of those when the interest rates are lower and you won't be able to roll over at 5%, will coincide with a period when the stocks are down and you'll actually want to use the cash.
Yeah. What about opportunities by way of gold and silver miners? They've been, I mean, you want to talk about depressed. I mean, these things have been beaten down to the ground for close to a decade now. Is now finally the time, or do we still have a ways to go?
No, well, I mean, first of all, let's recognize that the gold equities have had a strong move, basically since March, and particularly, this month. So they've had a very strong move. That's looking at price, not value. So, I mean, I don't like chasing things. I have very rarely, I don't like chasing things when they've had good moves. Having said that, if you look at the gold equities, first of all, the opportunity looks to me to be right. We've got a very, very negative sentiment at the moment on gold equities. If you look at the GDX and the GDXJ, they are continuing to get outflows, even worse than the physical GLD. So VanEck publishes the inflows and outflows to the GDX and GDXJ. And if you look at the last month, there's only been 3 days where they've reported net inflows. I mean, that is just amazing. With gold at record highs, you've only had 3 days of net inflows. I manage Peter Schiff's gold fund, as you may know, and I'm not allowed to say what's happening with our fund, but you can infer from what I'm about to say. I've talked to many gold fund managers in the US, and everyone is having the same issue. But yes, you're getting some days of inflows, but you're still getting many, many more days of outflows. And that's been going on basically since March as gold started to move up. So the sentiment is very, very weak. But I think the sentiment, and this sentiment's weak for the reasons that I've said earlier, the stock market's still doing well. If you can buy NVIDIA and become a millionaire, why do you want to buy Barrick? I think the sentiment is beginning to shift. It's beginning to shift. So we're getting more days of inflows in August than we were in July, more in July than we were in June. As the broad stock market becomes less of a certain one-way direction, you're going to start people locking in profits on some of the stocks that they've got and looking around for things that are undervalued to buy. That'll include, small cap value. It'll include foreign stocks. It'll include emerging market stocks. It'll include oil stocks, but it will also include, I think, gold and silver stocks. And again, as I mentioned, the macro environment for buying gold stocks is weak, but as things start to turn, then they become much more attractive relative to other equities. And then in terms of valuation, I said, obviously, the gold stocks have done very well this year. People think they haven't, but when a sector's up 25% in 7 months, that's pretty good. Let's not complain at that. but the valuations are still ridiculously cheap. You look at Agnico Eagle, for example, which is the third largest gold mining company in the world. And Agnico is a good example because there's no particular hairs on that dog. You know, their political risk profile is strong, their cash is strong, their mines are all operating well, they've got a good pipeline, etc. So nobody can point at Agnico and say, haha, that's the reason the stock's cheap. And yet Agnico, if you look at the cash flow they've had this year, it is trading at about 7.5 times cash flow. It is selling at the lowest price to cash flow within 1 or 2 percentage points in its entire history.
Wow.
Now, that doesn't make sense. You look at Barrick. Admittedly, Barrick has a very high political risk profile. So some people would say, well, that's the reason it's got a discount. Barrick has also missed some of their earnings estimates in the last 18 months. So that's another reason investors, you know, get a big negative. But on a price to book that net asset value, rather, again, Barrick is trading very, very close. Other than the last quarter of 2015, it is trading at its lowest price to net asset value in 40 years. Does that make sense? So the stocks are still very, very cheap. So I think we need to, I think it was Oscar Wilde who said there's a lot of people who know the price of everything and the value of nothing. Yep. I think we need to step back and forget that the stocks have moved pretty sharply in the last month and just look at the valuation and look at what the outlook is. So I would be hesitant to chase too much right now. Certainly the senior stocks that have done well. But I would certainly be very, very alert to any kind of opportunities, you know, to buy or enter positions. And one of the things that, one of the things we're doing is looking at good quality companies that have sharp declines because of specific temporary issues. A good example of that would be Franco-Nevada. When Franco announced, the largest royalty company, when Franco announced their second quarter earnings last week, I think, no, 2 weeks ago. When Franco announced they missed their earnings estimate because of problems at 2 of their largest royalties, one of which had already been announced by the company and one of which was new to the market when Franco reported. They're both temporary issues. The CEO of Franco actually said that in both cases, the mines are now operating back as expected. And they reiterated their full year guidance. And yet the stock, Franco, declined by its largest percentage decline ever. It declined by a larger percentage than when Cobre Panama was shut down. Now, does that make logical sense? Absolutely not. It's a reflection, and you've seen this with other companies, it's a reflection of just how negative the sentiment is, just how skittish gold mining stockholders are, but any bad news and they immediately sell. We saw this early in the year with Barrick when they missed their full year guidance. We saw with Pan American at the beginning of the year. We saw it last month with B2 Gold again. So I think if people are alert to the market and you look for good quality companies, and you never know which one's going to have this big decline, and you see a big decline like that on a temporary issue, so Franco would be a good buy, B2 Gold would be a good buy, Fortuna also was hit. For again short-term reasons. So we're looking for opportunities like that, and they just sort of come and go.
Right. So we've covered pretty much the gambit, or the waterfront of the commodities complex, as well as the precious metals complex as well. Adrian, anything else you want to talk about that we haven't really touched on yet before we wrap things up?
I think some of the exploration stocks are just remarkably undervalued. Okay. Summer's always a weak period for them. And of course, if they have big losses, they will be hit with tax loss selling. So, but I think some of those are just remarkably undervalued, and you want to be looking, in my view, the way I do it. Sorry, I'm not a geologist, so I'm not looking for a specific project that might have really good results in the very near term. I'm focused much more on the company, the strategy, the management, the balance sheet. If you've got a junior company with a strong balance sheet where they will not have to go out and raise more money, because I think that's going to become a little more difficult in the next 6 months or so. Some of those are just remarkable value right now. But you do obviously have to be patient, and you have to be alert to tax loss selling, the potential for tax loss selling towards the end of the year. I think also we are generally, as I mentioned, getting out of the developed markets. But you look at the Chinese and Hong Kong stocks, they are very, very undervalued. And of course, typically when something's undervalued, it's undervalued for a reason, right? I'm not saying there are not risks with buying Chinese stocks, but it just strikes me that the valuations are low enough. The risk reward potential is in our favor. The sentiment is so depressed that you could get a turn.
Right.
Same really for Japanese stocks. They've had a good run in the last 6 weeks, of course, but you're going to get a situation in Japan where as interest rates move up, which are going to continue to move up, they're still significantly lower, of course, than the rest of the world, but they're higher than they have been for 20 years. As interest rates in Japan move up, you're going to start to see Japanese institutions start to bring money back from their global bonds, US and Europe, and buy and put the money into Japan. And this is all going to happen at the margin, but of course, prices and moves are made at the margin. So I'm not suggesting that suddenly every Japanese person is going to suddenly sell all their dollars and buy yen, but at the margin, you're going to see that happen. And as that happens, two things are going to result. One is the yen is going to continue to move up, and one is the equities are going to continue to move up. So buying Japanese equities, I think, is a good buy if you have a 1-2 year horizon.
I see. Well, we've covered a good deal of information here, Adrian. I want to leave the audience with where they can find you and where can they hear more from you.
Yeah, www.adrianday.com is the easiest place.
Okay, we'll have that link down below. And guys, if you enjoyed this content, be sure to give us a like, comment, go, Adrian, go in the comment section if you agreed with Adrian. If not, let me know why. Really interested to get your take here, guys. And also, don't forget to subscribe to the channel if you haven't already. And I'd like to remind you to take advantage of special pricing on gold and silver by emailing info@milesfranklin.com and telling them the Capital Cosm sent you in the subject line. With all that said, guys, I'll catch you next episode. Bye, all.
Thank you very much, Danny. Thank you.